Welcome to our Monday night money panel. Joining us this evening is Jane Alm, an investment advisor with Angus Watt Advisory and National Bank Financial. In Calgary, we have Shafik Hirani, director and senior executive financial advisor with Investors Group Calgary, and Jim Yee, a financial educator and founder of retirehappy.ca. Last Thursday, the federal Conservatives made a move to give Canadians' retirement savings a boost through proposed pooled registered pension plans. PRPPs are meant to provide a viable option for the 66% of Canadian workers without a corporate pension. Jim, your business is all about retiring happy. So in your opinion, is the PRPP a way more Canadians can do that?
Well, I think there's good points and bad points about it. I mean, right now there are existing programs that people can use with a defined contribution plan, a group RSP plan, or a defined benefit plan. So I think that there might be a place for it where it can bridge the gap that exists between a defined contribution and a group RSP plan. But I think my main concern with the pooled registered pension plans is I think that with the recent release, it's missed the mark, in my opinion, on what's really causing people to save money. The whole point of pension reform is that there's a huge retirement gap. Not enough people are saving enough money for retirement. And I'm not convinced that the pooled retirement or pooled registered pension plans will necessarily fill that gap. I think that what the government needed to do was created more incentive for employers to put these programs in place and offer some maybe tax breaks for employers in their ability to match contributions. When you ask people who are part of a group RSP plan, why do you contribute to a group RSP plan? They'll always say, because my employer matches. So I think that's the primary driver of savings, and they needed to address that.
Jane, you're nodding here. Well, how have they missed the mark?
Well, I think they've missed the mark on a couple points. First off, with the pooled registered pension plans, employees have the option to opt out. If you can't afford to put it in, or you're spending most of your money and your employer is not matching it, as Jim said, you don't have an incentive. There needs to be an incentive to get people back into the idea of saving for their own retirement, so that they're not so reliant on the government as they go forward. So I think they really did miss it, because you're not going to convince someone to do it just because they have another option.
Now, Shafik, my understanding is that it's still at the point where provinces can still go over and look at how they're going to address this legislation. So is there a possibility that provinces, or one province in particular, could make this a mandatory contribution?
Yeah, there's a no, it won't be mandatory amongst any of the provinces, but there are some provinces that are for it, and there are some provinces that are against it. I know Alberta, the finance, and Quebec, ironically, which is rare that we actually agree with the Quebec government, but we were more against it, and Ontario was in favor of it. I think, here's the main issue. The main issue is that they need an adjustment to Canada Pension Plan, because Canada CPP is what's called a defined benefit plan, and a lot of people don't, it's not enough in retirement. And in Alberta, there's a high level of self-employed people, and these self-employed people are not maximizing their RSPs. So the government wanted to come out with an alternative, mainly for self-employed people, to contribute towards another tax shelter program. Their options were to increase CPP benefits, which really was a bad idea. I know the NDP wanted it, but that was a bad idea. They had other options like increasing the RSP deduction limit. This pooled registered pension plan is not a defined benefit plan, it's a defined contribution plan. And so it does provide an alternative. The good thing, like Jim said, is there are options. But like Jane said, there's a lot of things that it does miss. So I think it's hit and miss in this situation right now.
Jim, similar to what Shafik has been saying, some critics have been describing it, or have been saying, don't be fooled, this isn't a pension plan, it's actually a form of a savings plan. Can you elaborate on that a little bit?
Yeah, there was an article on Moneyville that Moshe Molesky wrote. He said this is not a pension plan. What he was really referring to the fact that it's not a defined pension plan. I think it still is a pension plan, because a defined contribution pension plan doesn't guarantee any income in retirement, but yet we call it a pension plan. So I think that was a sort of a sexy headline that maybe caught people's attention. But
including
I
mine.
think with all the sort of negative comments, I think one of the things that's important to bring to light is one of the good things about the PRPP, I think, is the fact that there is this strong emphasis on creating a low-cost structure, making sure that fees are low on these investment products because of the pooling effect, and that everyone's going to benefit from low fees. I think that in Canada, you know, many reports have said that we fail, the mutual fund industry fails in terms of our fees being high. I think that one thing it could do is bring a lot of awareness to Canadians about the cost structures of investment products. And so that's one good thing I think is coming out of it.
Great. Jane, we have to go to break shortly, but any final thoughts here?
Well, the final thought would be, remember, if it's a defined contribution plan, a group RSP type idea, that you have to make your own investment decisions, so you now have to become informed and educated so you know what you're choosing.
Great. All right, after the break, we find out what our money panel is watching on the markets this week. Stay with us. Welcome back to Alberta Primetime and our Monday Money Panel. Jane, you were mentioning that you'll be keeping an eye on the Canadian banks this week. Why is that?
Well, with all the volatility we're seeing and with the distress in Europe and the discussion about how this will affect banks, we're seeing bank prices, the price of bank shares come down. So we're looking for some very interesting opportunities. Yields are starting to get back to a point on the bank shares where they're starting to become attractive as long-term investments. So when you're looking for a longer-term investment, you always try and pick your time. Now's a good time.
And how long will this last, this period of being a good time?
Sometimes it's 2 or 3 days. Sometimes it can be a few weeks. I think right now it's really out of our control. It will have a lot to do with what's happening around the world in other sectors. So if you miss it this time, you're probably going to get another shot in a month or two, so don't worry about it.
Great. Shafik, what have you got your eye on this week?
There's a few things. Domestically, Mark Carney is giving a speech in Montreal tomorrow, and he's going to talk a little bit about the state of the Canadian economy. I know that they are trying to target a GDP of 2%, and they're trying to target inflation at 2%. So I'm kind of curious what he has to say on what's going on in Canada. But like Jane sort of led to, a lot of Canada is going to be based on what's happening internationally. So where I'm really looking internationally is on Wednesday, U.S. GDP numbers are out, and that'll give some clear indication whether the U.S. is going into a recession or not. If GDP is negative or down, then the consensus is for 2% growth. If GDP is down, that's bad. Also on Wednesday, U.S. unemployment's out. And of course, I'm watching the soap opera in Greece and Spain and the sovereign debt issues, as well as the American elections and the deficit. Those are the main things.
Jim, what about you? What are you watching, and what should Albertans be watching?
I think they should watch the hockey game, House, and Dancing with the Stars.
On the markets, come on now.
I got to tell you, it's pretty depressing news out there. And ironically, I had to ask Shafik what would happen to the markets today. I don't watch the markets. I try not to watch the markets, and I don't think people should watch the markets. I think it just creates people to panic. I think it creates a lot of unnecessary investor psychology that causes people to do the wrong things at the wrong time. You can watch GDP numbers, gold prices, dollars, all you want. And at the end of the day, you can't control it, you can't predict it. So just enjoy yourselves in the evenings.
So let's move on to that's good advice. Another way some people might enjoy spending their time is Christmas shopping. And something in the markets that we see sometimes is this Santa Claus rally. Jane, what is this? Is it a myth? Does it actually occur? How do we take advantage of it?
Santa Claus rally is a rally in the month of December. There's some people will say it's around Christmas time. Some people will say it's for the whole month. Sometimes it happens, sometimes it doesn't. Sometimes it happens for a couple weeks, sometimes it doesn't. So I would say, if you're saying myth or truth, I'd say more myth than truth.
And Shafik, there's other calendar-associated ups and downs, trends or myths. Where does this come from? Is it a pattern?
What are you laughing at, Jim? I'll tell you one thing, Emily. I don't think it's a myth. And if it were a myth, then every single month over time would yield you the same return. That's based on a guy named Markowitz that won the Nobel Prize called the efficient market hypothesis. So, December generally is a good month. 6 of the last 7 years, there's been a Christmas rally. I'm looking forward to this year because I honestly believe that the markets are going to recover right now. I think this could be one of the best buying opportunities we see in our lifetime. So what I'm looking for is the Christmas rally usually lasts from December 26th to the 31st. but December historically has got a higher average return than all of the other months. So it is considered to be the best time to invest. And the average return for December is like 1.6%, whereas the average return for, on average, the other months is like 0.5%. So there are even some months that you shouldn't be in. So I believe in the cyclicality of the markets. I believe that there is a potential, but for Albertans, the worry I have is people are so panic-stricken right now with gold going up and the world falling apart and sovereign debt and unemployment going up and the U.S. at $14 trillion in debt and unemployment at 9%, that people are going to miss the boat on this. And I would encourage people to really take a look at the opportunity that lies in front of them.
You've got to convince your friend Jim to look at the markets and invest in some stocks.
I know that.
Well, listen, if it were that easy, then we wouldn't be here, right? If you knew that December was always going to be a positive month, making on average, that's the problem with averages. They're incredibly misleading. You know, you can have a low of -10 and a high of +10, and on average, it's, 1. So I don't think anyone knows, and I think that it would be foolish for anyone to step up because of a proposed Santa Claus rally.
Jane, you wouldn't advise a client based on the Santa Claus rally?
No, I would advise them to do their investment based on the valuations, based on the fundamentals of the company, and then longevity. If they're looking for a dividend, is the dividend sustainable? Base it on those fundamentals. You'll be fine because you're investing for the long term. You're not investing for 1 month.
Now, we've only got a little over a minute here, but I do want to briefly touch on the Statistic Canada numbers. Inflation is down across the country, except in Alberta. Jane, why is this?
Well, in Alberta, as we talked about a couple weeks ago, we've got an economy that seems to be growing. We have natural gas and oil that are all being developed. We also have a little bit higher wages. With higher wages, generally comes higher inflation. So I think there's a lot of factors at play in that.
Sorry, guys, I wish we had more time. We're out of it, unfortunately. We'll have to save it for next time. Jane Alm is an investment advisor with the Angus Watt Advisory and National Bank Financial. Shafik Hirani is director and senior executive financial advisor with Investors Group Calgary. And Jim Yee is a financial educator and founder of retirehappy.ca.